Gavin, who is the senior market strategist at National Australia Bank, joins us right now for a very quick perspective. Gavin, I don't know if you're expecting anything dramatically different from the policy announcement today, or rather from the outcome today. Let me not say a policy announcement today.
No, I don't think so. It's one of those meetings where we don't have a Janet Yellen press conference. We simply get a statement, and that should be pretty standard stuff. We know the Fed has been talking about, strong economic output, or moderate economic output as they term it, a strong labour market. Household spending seems to be picking up quite nicely. Look at the consumer confidence numbers we got out yesterday. They're very strong, income and spending, and business investment has been picking up. The one issue that remains to be solved is this idea that inflation, wages and inflation is just not picking up. And we know that for some months now the Fed has been saying that over the short term, the 1 year inflation outlook looks set to be, or inflation looks set to remain below the Fed's target of 2%. But over time, over the medium term, they expect that to pick up. The problem with this is that as every month ticks past and inflation and wages do not pick up, the Fed gets perhaps a little bit more concerned or worried that this is not going to happen. And I should say, you draw that distinction between how the Fed has been confident to now that inflation and wages would pick up, and yet the ECB, as we saw last week, and some of the other central banks seem to be less confident, seem to be more aware of this dynamic that we have around the advanced economies where wages inflation is just not moving. And that's a whole complicated issue that is vexing the economics profession now. Lots of potential reasons for that. But I just wonder, we do not expect, and markets don't expect, the Fed to surprise with anything today. But if there were to be a surprise, it would probably have to be perhaps a more tacit acknowledgement that inflation in the short term is just not picking up. And if we were to see that, then the read-through from that, the implication would be that maybe they won't be so aggressive as they have been saying in terms of hiking rates. For instance, the market would then start to think maybe a December hike is not in the bag. The market might think that hikes next year will be less than they had otherwise thought. And of course, the read-through from that would be a lower dollar, lower yields, but probably even more of a boost for stock markets, which, as you know, seem to be going onwards and upwards.
Well, there is also an expectation that Bank of England would probably raise rates. In that case, what really happens to dollar? Could it correct? To what extent?
Well, you're right. I mean, so markets in the UK are sort of 85 to 90% priced for a move at the Bank of England tomorrow. That's been a long time coming. I would say that it's not completely guaranteed that they're going to hike. That we have had some mixed economic numbers. We've had numbers on retail sales which have been blowing hot and cold. The latest numbers were extraordinarily weak. We've had a few surveys which have been a little bit weak. The housing market seems to be rolling over. There's lots of comments and editorials about, the Bank of England needs to be careful here because, as we've just been explaining, there's no sign of wage or inflation across the advanced band of economies, and yet we do have inflation in the UK, except we know why we have inflation in the UK. That's because the pound fell after the Brexit vote, and we have inflation drawn from that. We also know that over the next few months, inflation from that point of view is likely to roll over. It's likely to peak, and it begs the question, why would the bank want to raise rates if it thinks that inflation is about to peak, and if it thinks that some of the economic risks are on the downside as we enter sort of, the nub of the Brexit negotiations? The bank's view is that with unemployment at a 43-year low, we're at that point where spare capacity is being eaten away, and it really needs to start the process of hiking rates now to get ahead and make sure that it doesn't have to hike rates more aggressively down the road if it gets behind inflation, and thereby that would be more of a risk to the economy. So there are two sides to this argument. I mean, overall, it's likely that the bank will move tomorrow. What's going to be really important in terms of market reaction is the way that the Bank of England describes that, the characterisation and the kind of forward guidance that the MPC give in terms of, is this likely to be the first of a series of hikes? Now, the reason the bank is giving for hiking seems to be one which is, less spare capacity, and that in itself suggests there may be a series of hikes, maybe from, 0.25
FOMC meeting
where we are now.
and the announcement of new Fed chair. Which one do you think is the more important decision that market will be keenly watching for?
Oh, I think the most important thing is probably going to be the Fed chair. I mean, we know that's going to be probably coming tomorrow. We also know the tax cut announcements, which were due today, are now going to be coming tomorrow. Of course, this is just a bill that the House of Representatives will be putting forward. It's still a long way to go, probably nearer Christmas, maybe even into next year before we get an actual agreement on that. So there is a risk that markets are being a little bit too more optimistic on the tax side. They may have to wait a bit further from that. In terms of the Fed choice, we know the two front runners, or we're led to believe the two front runners are Jerome Powell and John Taylor. There could be starkly different market reactions from this. We'd suggest that Jerome Powell, which is the favoured front runner on our guess, he would be slightly negative for the dollar, probably sideways on benchmark yields, because whatever you would say about him being pretty similar as Janet Yellen and slightly dovish is a downside threat to yields.
Okay.
On the other side, he's pro-deregulation, and that will be positive for yields and positive for stocks. John Taylor, on the other hand, will be much more hawkish, and the dollar will go up on the back of that, as will yields.
Okay, Gavin, thanks a lot for taking time out for us.